Having a balanced approach towards portfolio construction is very important for securing sustainable returns. There are economically highly sensitive sectors, then there is economically low sensitive sectors. Solitaire, our multi-cap product, has balanced its exposure to dodge the swings of the economy. Join us this coming Saturday to take the walk down the memory lane and celebrate 4 years of Solitaire.
Friends, in this video for I Thought Wealth, I'm going to talk to you on the topic swimming in high tide. The high tide that I am talking about is in two parts of the Indian stock market. The first one is mid cap, the second one is small cap. I see that millions of people don't want to be left out of this high tide. Everybody wants to be swimming in this high tide. Now, why do I call this a high tide? Firstly, valuations are rising based on flows, liquidity. The valuations don't really have a justification basis. If you are trying to sell businesses, if somebody is selling a business in these spaces, the deals are happening at valuations lower than the market valuations, or businesses are not saleable at these valuations, but investors are willing to buy out promoters at these valuations. Promoters are selling not to business owners, but to mutual funds and large HNIs and institutional buyers. So, business owners think that this is not a time to buy businesses simply because the valuations are too high for their comfort. But investors seem to demonstrate an overconfidence, which is quite uncharacteristic. So, I think that this is a high tide as far as these spaces are concerned, and investors feel compelled to swim in this high tide. You all know that when you are going up, it feels nice when the waves are going up. Actually, you know that the sea is a little rough, but you enjoy the moments. That is what swimming in high tide is all about. If you have done sea swimming, you will know that. You like getting thrown, then you go back once again, you want to get thrown again. It is all from the outside looking like fun. But the high tide example has been used so effectively in the investment world, because what follows high tide is low tide. So, what happens when low tide happens? When low tide arrives, you suddenly start seeing things more clearly. Until then the waters are high, so you did not see who is swimming naked in the high tide. I think that in this market a lot of institutional investors are swimming naked because their clients are giving them too much money and asking them to invest it immediately. Is there a compulsion to invest immediately? I think not, but there are products, and most products in our mutual fund ecosystem run to that rule that money is being given only to be invested. So, they will invest, they will not take cash calls. And in all this, we are thinking that high tide is going to last forever, or high tide will become higher tide, which is a very rich expectation, because high tide will only be followed by low tide. Yet, when market is experiencing high tide, everybody thinks it is going to last or get better. It is that expectation which is making people pour in so much money through the SIPs, through lump sums. And when they pour so much money into these funds, the asset management companies are simply not able to say no. We see this weak, feeble protests where one day they say that it is not a good time, and then they withdraw that note after a few days. Now, I think that business compulsions are prevailing here. Clearly, the industry has taken a call that asset gathering is more important than wealth conservation. The attitude seems to be, let us gather the assets when they come and then let us see what we can do with it. Let us see how we can contain the damage later. This again is not new. In every cycle, thematic funds have gathered assets which ought not to have been gathered have created scale which would become eventually unmanageable. And what happens after that? They scale down because investors move out, they take the money out. So, the investor again single-handedly corrects that mistake of misallocation of capital. The management does it, the managers don't, the trustees don't, nobody does, the investor does. When he realizes it is the wrong time, but for now everybody wants to be swimming in the high tide. So, they are pouring money into these expensive parts of the market in the hope that they will become more expensive. They probably may for a brief period of time, but the adage that what follows high tide is low tide is yet to sink into people's minds. They still think what follows high tide is higher tide. Maybe the waves can get higher, the sea can get rougher, but that still means that you should not swim in the sea at that time. It does not mean that you can swim till then. That is where I think the investors have got their call completely wrong. Most of the investors are doing it on their own free will. There is no advisory push to do that. In fact, I see a lot of investors argue with me that they must invest in small cap and I tell them it is not a good time. I leave it at that. I do not push people, but I see that they are pushing and they are pushing in the wrong direction, and there is nobody to stop them when they are pushing in the wrong direction. And that brings me to one basic thing that investors always regret later. When somebody is doing a mistake, if they do not have anyone to tell them they are doing a mistake, they will do the mistake till it becomes too late. And then when they are living alone in regret, the thought that comes to my mind is, why did somebody come and stop me? So, that is the paradox. When somebody comes and stops you, you think that do not stop me, I know what I am doing. If nobody stops you and you regret later, your regret is, why didn't somebody stop me? There is a third thing where somebody stops you, you insult them, you do not listen to them, and then later when you regret, you cannot face them and you think that chap told me, but I did not listen. But even that you will not be able to publicly accept. All these are setting up investors for very unpleasant experiences later, and in my view it is completely avoidable. When valuations are not in favor, you must defer your investment. You must take out money when valuations are excessive and frothy. You must safeguard your capital when it is a time to take money out. You must see your portfolio very closely to see where excess valuation is and remove money exactly from there. You do not have to take a secular portfolio call, but where there is froth you need to act. If you fail to act, then you are going to live to regret it. High tide is the time when most people fail to act. Very few people act, but those few people are the ones who stay in the market, grow in the market and thrive in the market. My sincere hope is you become one of those few people. Thank you for watching this video.